Continuing on, compute overhead, controllable, and volume variances. So slightly different than material and labor, okay? Overhead has got some different components, different formulas. What I would do, in fact, I think what I'm going to do here is this is where we're at. We are going to compare actual overhead to applied overhead. So, like applied meaning allocated overhead. All right. The total difference is our, let's see what we call this. We call it our controllable overhead, I believe. Bear with me while I look for my PowerPoint slides. Bear with me. Bear with me. We calling it the overhead variance. That makes sense. That makes more sense. We're calling this entire difference the overhead variance. And it's the difference between actual overhead and applied overhead. Okay? Now, what I'm going to do is I am going to insert flexible budget, budget overhead. Okay? And then let's just make sure we get all the terms correct. We are going to call this first one volume variance. And volume variance is budgeted overhead minus standard. Man, killing me. Killing me. These slides are all wrong, unfortunately. The slides are all wrong. Okay, so overhead variance, right? The overhead variance is everything, okay? The overhead variance, again, is standard overhead applied, and I'll get to what that is, minus actual total overhead, okay? So this right here is the overhead variance, all right? Which means that budgeted overhead minus standard overhead applied is the volume variance. And I think that's still right. So it's budgeted overhead minus standard overhead is the volume variance. So this slide right here is the total overhead. So that just makes everything super fucking confusing. Okay? So again, total overhead variance is the difference between overhead applied and actual overhead. And then the first section that we're going to talk about is the volume variance. And that formula is budgeted overhead minus standard overhead applied. Okay? And so budgeted overhead, they're just going to give you that all the time. Okay? Now, standard overhead applied, that I want to talk about for a little bit. So if you think about standard overhead applied, that is going to be standard overhead applied is going to start with our overhead standard rate. Remember, so at the beginning of the period, right, when we were, man, this is like chapters a while ago, right? So we're saying, listen, we need to determine our predetermined manufacturing overhead allocation rate, our predetermined manufacturing overhead allocation rate. We're going to allocate overhead, right, based on the predetermined manufacturing overhead allocation rate. And the way that we will do that is we will determine an allocation base, and then we're going to determine how much of that allocation base we think about using, and then we're going to do the calculation. Okay. So our predetermined manufacturing overhead allocation rate, the first thing we do is we predict our budgeted overhead, right, at the beginning of the year. And then we predict our allocation base, how much we're going to use. So I don't know what we want to do, but we could just say, hey, you know what? My anticipated overhead for the year is going to be 1 million. And I'm going to allocate that based on direct labor hours. And I think I'm going to have 100,000 labor hours. And if that's the case, then I think I'm saying, God fucking help me, I can't do this in my head. But for every labor hour, we're going to allocate $10 of overhead. That's not the example that we're using in the slides that I'm going to show you in a second, but I just wanted to highlight this with actual numbers. Okay? So this is the standard overhead rate. This is how we're going to allocate overhead. Now, during the year, right? During the year, I'm going to allocate, right? Here's my predetermined manufacturing overhead allocation rate. And I'm going to allocate, this is really important, based on the standard amount of the allocation base, all right? Times the actual production. So if I'm saying, hey, you know what? Again, I'm not going to use the same numbers, but I'm going to produce 1,000 units. And I think every unit is going to require 2 standard hours of labor. Okay? My allocation base is going to be 2,000 hours. Right? Then I will multiply that by my predetermined manufacturing overhead allocation rate. Okay, so in this particular example, we don't even need to look at that. We could just say we're going to use our predetermined manufacturing overhead allocation rate times the number of units that I produce times the standard quantity that I anticipated. Okay? And so in this particular situation, they're telling us, hey, you know what? Again, I can go back to this. Our actual overhead, they're telling us simplicity, our actual overhead, 18,150. My actual overhead, 18,150. And now they're telling us the overhead applied, 17,500. 17,500. And therefore, my total overhead variance, 650,000. Geez, $650. Getting ahead of myself. Unfavorable, right? We under applied. We have to apply another 650. And now we know the formula, right? Now we know the formula for this first one, which is volume. The volume, that is standard overhead applied minus the flexible budget. And now we need to go find out what our flexible budget assumption was in these PowerPoint slides. And in these PowerPoint slides, they're telling us it's 19,000. So they gave us this, right? This is usually given. This is usually given. And this we need to learn how to allocate, right? But in my example here, I have a flexible budget of 19,000. I applied 17,500, and therefore my volume variance for overhead is, what would that be? 1,500. 1,500. Unfavorable. Remember, we under allocated. So forgot to do that. Under. And now I know that my control, we're calling this our controllable variance, even though I don't know how to spell it, controllable variance. And that's the difference between the flexible budget and the actual overhead. And in this particular example, it looks like I have an 850 favorable, right? So I thought my overhead was going to be 19,000, and it turns out it was only 18,500. So a controllable variance of 850 favorable and a volume variance of 1,500 unfavorable gets us to a total overhead variance of 650. I am not a big fan of these slides. This slide is actually okay, right? So this slide is giving us this calculation. I like that. But the previous slide got the box wrong. So I like it. This should be 650 unfavorable. And that is overhead. And this is a good summary, right? So our direct material variances, that could be the price of the material, the quantity of the material. Labor could be the price of our labor versus the quantity of labor. And then this is what we just went over, controllable variance and volume variance.